We have seen some volatile markets in recent sessions, lots of geopolitical developments out there, but our guest today says if you look past the noise, there are some positive signals for the markets. Joining us now to discuss is Ben Gossick, Managing Director and Co-Head of Global Equity Portfolio Management with TD Asset Management. Ben, welcome back to the program.
Thanks for having me back on the show. Excited to chat with you, Greg.
Lots to chat about as well. It's a holiday shortened week for the Americans for trading. Of course, they went into a long weekend. Some people were saying that Iran was top of mind heading into the weekend. By the time we came out of it, it was Greenland. In the end, a lot of headlines, a lot of noise. You're saying look past it. What should we be looking to?
The way that we started 2026 is almost like we started 2025 with so many different policy changes. There's a ton of domestic policy changes in terms of capping interest rates and then obviously international forays. But there actually is still a lot of positivity going on. When I look around, markets are at new highs around the world. So it could be Canada, US, Japan, Europe. But what I've noticed is that a lot of the same trends that have been driving these indices continue to persist. So I know a lot of people think we rotate around the sun, there must be something new. It's a lot of the same that I'm seeing, Greg.
The same. So let's talk about some of the things we've been seeing in the markets, because for a while, everyone was focused on the Magnificent Seven. They haven't been so magnificent, and yet we have markets closing at new highs without them.
Yeah, so I understand that the Mag 7 take up a big weight of the indices. And if you're just owning a portfolio of S&P 500 or TSX 60 or MSCI EAFE, I understand why you'd be very focused on these particular stocks. But being an active manager, we're looking for lots of opportunities, again, based on secular themes and trends. And this has been a very broad market and much broader than people give it credit for. That diversification has been going on, I'd say, for the past 2 years. And only now people are talking about, because they see the Russell 2000 move, it must mean that other stocks are moving. I will say this, Greg, Microsoft has been underperforming. Apple has been underperforming. Depending on the week, there may be a positive or negative catalyst for Tesla. It's hard to stay on top of that. Broadcom has been lagging. I'd say, Meta has been lagging. When I look at the Mag 7, I would just say Google, the one that everyone had written off, has actually marched forward and looks to be the leader of that 7.
Okay, let's talk about what the markets are rewarding these days. You say it is bottlenecks. Walk me through that thinking.
Yeah, so as we're going through various stocks, what we've been picking up is So I'll say there's 2 things that I know about markets. They reward growth, and especially if that growth is led by pricing power. Because if you're a company and you can raise prices and you keep your expenses the same, it flows right to the bottom line. So we like that type of story. And asset prices tend to trend. They can trend up, they can trend down, they can trend sideways, they can go sinusoidal, but they do trend. And so what we're looking at here is, obviously AI, the data center, power, these are very key themes that are driving markets. But specifically what the market has been rewarding, and like I said, they're not rewarding Broadcom right now. NVIDIA's been going sideways. They've been focused on the areas in the data center where there's just not enough supply. And this is why if you've seen companies like a Micron or a Western Digital or Seagate or the companies that make the machines that make the memory have all been going vertical, it's because effectively they've sold out of 2026. And now we're talking about how much might be sold out in 2027. And it's because the roadmap for these NVIDIA chips and these GPUs that power the data center, every new design requires even more memory. And there's just been a shortage of memory. And that means that these companies have pricing power.
That sounds like a good news story for those companies that produce the stuff, not such a good news story for the end user of those components.
Yeah, and this is, again, I'm always fascinated by markets and how humans, if it's great for them, it must be bad for someone else. And the market has really sort of figured this out. So if everything that we use in our lives has got circuits and memory and CPUs. And so you can imagine if everything is being dedicated now for memory for the data center, well, then it must be impacting other areas. And one of the areas that we are seeing is consumer electronics. And so we haven't seen the companies report yet, But the market doesn't want to wait for that. They've already started to anticipate that companies like an Apple, like a Nintendo, like a Sony, so major consumer electronic companies are going to have difficulty in terms of handling those inflationary forces that they're seeing in their cost base from these memory devices. So maybe a company like Apple might be able to try to manage that. But if we look at a company like Nintendo, already the market's anticipating that this is going to be a problem in terms of their margins.
Interesting stuff there. Let's talk about banks and insurance firms. How are they looking?
So banks in general have been looking great. Banks in Canada, banks in the US, specifically money center banks and investment banks, and then banks in Europe. I've tried to pound the table with you many, many times on this show. Was not a 2025 story, but has been a story for now the past 5 years. Even banks in Japan are breaking out to new highs. In particular, I'm very focused on Canadian banks. I know we've been flashing the charts, we haven't really focused on it, so maybe we'll spend a little bit of time on this chart. This is a line that represents a tug of war, Greg, between Canadian banks and the TSX 60. And I've tried to really highlight that with an arrow pointing up and an arrow pointing down. So if you see this curve pointing up, it means the Canadian banks have relative strength. And if we start to see that go down, the Canadian banks, you may say, hey, they're up 2%, they're up 3%. But if the TSX 60 is up 10 because gold's rallying, well then as an active manager, you're underperforming by owning these banks. So that's why this is really important. This particular chart was very helpful last year around this time because this is when Trump initially came after Canada and Mexico in terms of trade and tariff and all that type of stuff before Liberation Day. And we got a glimpse of what could be our future in terms of what we saw, within, let's say, the last 48 hours in terms of thoughts about Greenland and the Arctic and trade and all that type of stuff. And so you could see the Canadian banks start to pull back a bit. Now, no chart goes up and all the way, so stocks do tend to move forward, pull back. But you're watching that and you're watching the same sort of stuff going on and you start to think, could there be, is this the market starting to think about USMCA or CUSMA and where they think Canada sits in the negotiation table? We have seen some bit of a relief, so it's crazy yesterday. We think we're going, Trump's going really hard on Greenland, and then within a few hours we have a deal. There was a relief rally in the Canadian bank. So I would say since last year, the people that invest in Canadian banks have looked past USMCA, CUSMA. I do think that started to creep up into their attention. Where do we stand? What could be the resolution? But a deal wants to be made, and that's typically been has been the game plan from this presidency and this administration. So I think that's where the stocks have been going.
Okay, so there's the Canadian banks. How about insurance firms, and how about the credit situation?
Yeah, so insurance is a theme I really like. It's a service that everyone needs. Every well-functioning economy needs insurance. We had this great cycle, they call it a hard market, where companies are able to raise their premiums, but now we've shifted into a soft cycle. And this is when the stocks tend to underperform. What people are looking at is a basket of US insurance companies relative to the S&P 500. And so I'd say, kind of late first quarter, early second quarter of last year, just pushing to new highs, and they've been unwounding themselves. So there's just the natural order of things. There's a cycle, and you have to understand you want to be overweight when we have a hard market. You want to pull back capital when you have a soft market. But what I want to highlight, and I think this is going to be a theme that persists all year, we are talking about affordability in the US, particularly around utility bills, but I also think about insurance premiums. And insurance premiums, when it comes to the individual, like whether you're insuring your house or your car as opposed to a business insuring their business, is controlled by the government. And we have 36 governor races in the US this year. And so this is going to be a key top of mind. Why is my utility bill going up? Because there's data centers that are coming into my neighborhood. And what are you doing about these insurance premiums? Because it's getting ridiculous to insure my house and car.
That's the insurance. Let's round out the conversation with credit. You say it's looking better.
Yeah. So, people can turn on the TV, they can read the newspaper, they can get emotional about what they're seeing. But one thing that is important about markets is credit. This is a society and economy built on credit. This is comparing high-yield corporates. So this would be the riskier area of the bond market relative to U.S. Treasuries. And I've tried to match the durations here. And U.S. Treasuries, let's assume, being the safest form of paper. We had been sort of, as we entered the year, we were sort of rolling a bit, which was giving me some pause, but we weren't broken. But now this is re-accelerating in favor of the high-yield corporate. So if they're pulling on the tug of war, that little flag starting to move towards them, that just tells me that investors are feeling more confident about credit. And if they're feeling more confident about credit, I think that's good in general. And it does match up well with all the other measures in terms of risk on, risk off. So you may see certain stocks up and down, but in general, I'd say the environment is quite healthy.